It turns out the biggest gold discovery this year was not in the Andes. It was 3,000 kilometers beneath your feet. According to new research published in Nature, Earth's core is leaking. Scientists have detected traces of ruthenium, a precious metal tied to gold deposits in volcanic rocks from Hawaii. Their conclusion? Some of the gold we dig out today might have started its journey in the planet's molten core, hitching a ride to the surface through superheated plumes of rock. It sounds like science fiction, but it is real. The Earth's core, long thought to be sealed off, is apparently contributing material to the crust. Billions of tons of superheated mantle rock rising up, bringing whispers of gold with it. So yes, Earth is still making gold deposits, slowly, painfully, invisibly. But the problem? Well, these processes operate on a timescale that makes even the mining industry look fast. You cannot drill for this gold. You have to wait for a volcano. And while this discovery might excite geologists, it does nothing to change the reality facing gold investors today. Global mine production is peaking. 2025 marks the likely high watermark for gold supply, with production expected to climb by as much as 17% in 5 years' time. The easy gold is gone. What remains is deeper, costlier, riskier, and slower to bring to market. Which brings us to the Andes and a far more immediate question. If we just found 32 million ounces of gold up here, does that solve the global supply problem? A new gold discovery in the Andes has just been valued at over $300 billion. 32 million ounces of gold sitting 4,700 meters above sea level in the middle of nowhere. It is being hailed as a game changer. Some are calling it the end of the gold shortage. Others say it proves all that talk of peak supply was overblown. Headlines are glowing, and commentators are getting a bit giddy. And investors who have spent the last few years building up physical positions are wondering if they've been outplayed by a mountain. But before we decide if this really changes anything, let us step back. First, what was the state of the gold market before this discovery? And second, does one remote deposit actually solve the structural problems in global gold supply? Because once you consider how long it takes to bring a project like this online, how much of that metal is even extractable and what demand looks like right now, the picture changes. This is a big find, but it is not a fix. Gold production in 2024, just last year, set a record, 4,974 tons in total supply, up only 1% from the year before. But that bump did not come from mining. Mine production was flat. The increase came from recycling, which jumped 11% to over 1,300 tons. In other words, the industry had to raid jewellery boxes, dental offices, e-waste bins just to keep the wheels turning. And that is the story that we have seen for years now. Mine supply has hit a ceiling. The World Gold Council calls it stable, but we might call it tapped out. Forecasts show that gold mine production will peak around now, this year, or in 2026, and could decline by 17% by the end of the decade. That's not a small correction. That could be a structural downturn. Why? Because the big, easy deposits have all been dug up. The rest is locked in awkward geology, politically unstable regions, or somewhere under a glacier. And new discoveries? Well, those have dried up. The last few years have seen record low numbers of major finds. Between 2020 and 2024, only 5 major discoveries were recorded, totaling just 17 million ounces. Well, that barely scratches the surface of annual demand. And the average new discovery has been getting smaller. Since 2020, new finds have averaged 3.5 million ounces. Compared that with the 5.5 million ounces on average over the previous decade. It is a game of diminishing returns. Explorers are spending more to find less. So going into this year, we were facing a simple equation: weak new supply, high production costs, and an exploration pipeline that looked like a drip feed more than a gusher. And then Felo Doul landed on the desk. 13 million tons of copper, 32 million ounces of gold. The headlines wrote themselves. But really, what did they mean? So let us assume for a moment that all 32 million ounces are economically recoverable, which they aren't, but we will play along with that idea. Global demand in 2024 was 4,899 tons, or roughly 157 million ounces. So this one deposit represents about 20% of 1 year's demand. Sounds good? Except it isn't just 1 year. It's not even 5. Getting a mine of this scale operational is a decade-long project at a minimum. And that is if everything goes according to plan, which in mining is a little bit like assuming that a British summer will be warm and dry. Technically possible, wildly optimistic. We are talking about one of the most logistically complicated mining environments on Earth. The project sits in the Andes, straddling the Chilean and Argentinian border. That means 2 sets of governments, 2 sets of laws, and double the chance of a political hiccup. There is little infrastructure, high altitude, seasonal access, harsh weather. Building a road would be a major undertaking. Building a mine, well, that is an expedition. And then come the permits, the environmental reviews, the community consultations, the taxes, the royalties, and, because this is South America, the ever-present risk of policy change. Chile has already tried to rewrite its mining laws once in the last few years. Argentina is on its 5th economy minister this week. So even if Felo Doul goes ahead, it will be a long, expensive, and politically fraught process. No one is pouring bullion out of the mountain next year. So back to the big question, will this discovery change the trajectory of global gold supply? In a word, no. It is significant, yes, but it does not reverse the structural issues in the industry. Exploration is still lagging. The average cost to produce an ounce of gold is still at record highs, and the rest of the pipeline is thin. What Felo Doul does is shows us that the large deposits still exist, but they are rare, they are difficult, and they take years to bring to market. They do not solve the short-term supply crunch. They do not offset this coming decline. They might soften it slightly 10 years from now. And in that time, demand is not going to disappear. It just is going to keep growing. According to the 2025 In Gold Retrust report, central banks purchased over 1,000 tons of gold last year, setting a new all-time high. So that equates to roughly $100 billion worth of metal. The annual average between 2010 and 2021 was just 473 tons. So recent buying is not just strong, it's extraordinary. And in the final quarter of 2024 alone, central banks bought 365 tons. The first quarter of this year, they added another 244 tons. Nearly a third of all gold mined today is now being absorbed by these public financial institutions. And as of February this year, total global central bank gold reserves stood at 36,252 tons. The relative share of gold in total reserves has doubled since 2016. And the motive? Well, according to the World Gold Council, the top reasons are long-term store of value, performance in times of crisis, and diversification. And sanction resistance and systemic risk hedging are increasingly cited by emerging markets. Poland added nearly 90 tons in 2024. India added 72.6 tons. China apparently added 44.2 tons. Central banks in the Czech Republic and Kazakhstan also increased their holdings, while Kazakhstan, Singapore, and Thailand split theirs slightly. But the overall trend is upward, especially in the East. And the private sector is following. Gold bar and coin demand in India rose by 30% in 2024. In China, it rose by 20%. ETF demand in the West, long subdued, is finally showing signs of life, with the first quarter of 2025 seeing notable inflows from both North America and Europe. This demand is not about jewellery. Jewellery demand fell 11% globally in 2024, led by a 24% decline in China. And high prices, of course, played their part, but the rise in investment demand more than offset that decline. Investors aren't buying gold to wear. In markets like China and India, their demand increasingly reflects their investment motives, not adornment. Easier access to bars and coins is also changing the way that people accumulate gold. They are buying it as insurance. So what is emerging is a gold market defined by 3 forces. First, peaking supply. The mining industry is aging, exploration is stalling, and discoveries are smaller and slower to develop. Second up, rising demand, led by central banks and long-term investors seeking to de-risk from fiat and geopolitics. And third, geopolitical repricing. Gold is increasingly valued not as a commodity, but as a strategic asset, something that governments hoard, not just hedge. Against that backdrop, Felo Doul is interesting, but it is not a silver bullet, or a golden one for that matter. So no, this discovery does not mean the gold shortage is solved. It means that when the market sees a 32 million ounce deposit, it might breathe a sigh of relief that it is probably not earned. Because here is the thing, discoveries are not production. Inferred resources are not deliverables, and giant deposits in inaccessible places do not help you to solve a supply crunch today. If anything, Felo Doul should reinforce the point. Gold is hard to find, it's harder to mine, and getting harder by the year. Even the Earth's core seems to know that. It is sending up signals, slowly, steadily, just a few atoms at a time. A reminder that gold's true rarity is not just a market feature, it is a planetary truth. And that is why we hold physical gold, not because it is easy, because it is not. So until next time, why do you think about this? Get on board, download your exit plan. It's in the link below.